Welcome back to DIY Finance Guy. I'm Sergey Modilevsky. The Bank of Canada is going to be increasing interest rates 3 more times over the next 3 meetings in October, December, and January, with the total of those increases reaching at least 1% higher than today's current rate. The probability of a hike of 75 basis points at their upcoming meeting on October 26 has jumped to 60%. This became an essential certainty after the release of today's Consumer Price Index report for the month of September. With the 1% increase in mortgage rates, adjustable and variable rate mortgage holders are going to see their payments increase by about $48 for every $100,000 of mortgage that they carry. Today's inflation numbers may appear high, but on their own, don't tell the full story of what's happening with inflation at this time. You need to understand these details before making any changes to your mortgage or completing the purchase of a new home, so stick with me. Before I jump into it, please look down, hit that like and subscribe, hit that notifications bell so you get these videos every time they come out. Let's jump back into it. Canada's annual inflation rate slowed to 6.9% in September of 2022, much below the 39-year peak of 8.1% that was hit in June, but slightly above market estimates of 6.8%. We continue to see a slowdown in transportation costs, largely due to lower gasoline prices and an increase in the supply of global crude during that month. But we want to look over the longer trend to try to understand these things. So looking back, we could see in June 8.1, and we've since trended down to 6.9%. This is the headline number, which includes everything from energy prices and food all the way through goods and services. This is the broadest measure of inflation within the Canadian economy, but is not the only measure of the Canadian economy. We could see a steep incline since October of last year, but the last 4 months have shown a general downtrend. This is not necessarily the most important metric for the central bank. In Canada and the United States, they've made it clear that the most important metric for them will be core inflation, which excludes the 2 most volatile items, which is food and energy prices. So let's have a look at that next. We've seen a general downtrend since the month of June from 6.2% at the peak down to 5.8% with a recent rebound from the month of August to the month of September from 5.8 to 6%. That's a result of a broadening of inflation. It's starting to entrench itself specifically within services. That's why core inflation is a bigger concern for central bankers. We've looked at core inflation on a year-over-year basis, but it's also important to track these metrics on a month-over-month basis because we got to understand that on a year-over-year, prices had been depressed, and we were comparing against a lower benchmark of prices, so that magnified on a year-over-year basis how consumer prices had grown. Looking at it on a month-over-month basis shows that despite a high cost basis, core inflation is still growing in an aggressive way at 0.4% compared to the forecast of 0.1%. At a monthly rate of 0.4%, that means we're still annualizing at a rate of 4.8%. That's more than double what the Bank of Canada's target is, which is 2%. That's unacceptable for the Bank of Canada, and as a result, they're going to continue hiking interest rates, as I mentioned, 3 more times over the next few months, in all likelihood, or fewer number of times, but totaling 1% or higher. In the headline inflation report, let's take a deeper dive to see which categories of spending have been most affected. In fact, prices have increased at a faster pace in September in 5 major components on a year-over-year basis, and on a month-over-month basis as well. We can see that the cost of food increased 9.8% in August to 10.3%. Shelter costs increased from 6.6% to 6.8%. Household operations, furnishings, and equipment also grew incrementally. And alcohol, beverages, tobacco products, and recreational cannabis also saw growth. We could see that the core inflation was broad-based across many categories. These are sort of the lagging costs that we've seen accumulate over the last few months as inflation, as producer prices have ratcheted up. Does this tell the whole story? In fact, it doesn't, and let's take a deeper look at why to help shape any decisions that you make moving forward. I want to look at what we can expect moving forward based on a lot of leading indicators. I want to take a second look at the Canadian headline inflation rate, which includes food and energy prices, and instead of looking at it on a year-over-year basis, I want to take a look at a month-over-month trend. And we want to look back at the last 4 months, from June through September. We could see a declining trend of growth. The total growth over that period, including a declining month in August, saw total growth of 0.4% from June through September. If we look at the 3-month trend, we could actually see a trend of growth that's at 0.3% from the month of July through September. Over a 12-month trend, we could see a significantly declining trend of growth, which sets an expectation of what we may be able to expect moving forward. That doesn't tell the full story. We also want to take a look at commodity prices, shipping costs, and additional input prices that affect what producers and wholesalers pass on to consumers down the road once consumers are buying these items from retailers. So let's have a look at that next. Let's look across the board at some of the major commodities and how their prices have fluctuated since August 1st. We know that we saw peak inflation around that month, and these are some of the input costs that greatly affect the products that we buy and that affect the consumer price index basket. Looking first at the cost of gasoline, we've seen a downtrend in price. We don't want to be oblivious to the obvious, which is in the United States, which is where these numbers are coming from. The federal government chose to empty their reserves in order to bring down the cost of gas. It may not be possible to do that in the long term, so we may still see a spike in energy prices past midterm elections, but since August, they've trended down about 11%. Natural gas has seen a significant downtrend in prices, peaking at around $8.28 at the start of August, since then trending down nearly 33%. Copper declined about 5.5%. Food has remained stubborn. It's well below its peaks, but it is still stubbornly high. It's seen about 11% of growth since August and about 5% in the price of wheat. So 11% in corn, 5% in the price of wheat. Lumber has traded more or less sideways, seeing about a 3% decline, but shipping prices have seen a precipitous fall. So that is global container shipping prices, aggregated, has fallen by about 44% over that time. It takes a long time, 3 to 6 months, before that will trend through from wholesalers to producers to retailers and eventually down to consumer savings. But a lot of commodity prices and logistics costs are leading us to believe that we're going to see lower producer prices, raw material prices in the months and quarters ahead. Speaking of raw materials, let's have a look at how those costs have trended since August. In the most recent months in September, we've seen a raw material price decline of about 3.2% in that month. That was following a 4.3% decrease in the month of August. Prices for crude and other energy products fell by about 3.6% for a third consecutive monthly decline. Prices for logs, pulpwood, natural rubber, and other forestry products also tumbled nearly 12% for a record month-over-month drop. We're now starting to see a significant trend of declining prices since the month of June. Next, let's have a look at producer prices. Producer prices in Canada went up by 0.1% on a month-over-month basis in September after 3 consecutive months of decreases. Prices increased for motorized and recreational vehicles, mainly motor vehicle engines and motor vehicle parts, and pulp and rubber products, partly due to a strong dollar. On a year-over-year basis, producer prices rose by 9%. Although very high, that's the least in 18 months, slowing from a downward revised 10.2% in the previous month. Let's look at the longer trend. We could see that over a 12-month period, there was a large escalation in prices from October 2021, as in almost every other category, and then those prices had started to come down after peaking in March of 2022. Over the last 4 months, we've seen a sort of precipitous decline in prices. We'll have to make sure that this trend continues, but right now we're seeing very positive downward pressure on prices. These are producer prices. A moment ago, we had just looked at raw material prices, which are some of the inputs for these producer prices. On October 28th, we're going to receive the next GDP month-over-month report in Canada. But until that time, let's have a look at how GDP has printed since March of this year. We peaked out earlier this year at around 0.8% in February. Since then, we've seen a precipitous increase in cost of borrowing in Canada, and as a result, GDP growth has essentially evaporated. We haven't headed towards an outward decline, but we may in fact see that for the first time in the month of October. The probability of a recession, with now there being more or less a consensus across major bank economists that a recession will follow, whether it be in the fourth quarter of this year or the first quarter of 2023. What I want to do now is have a look at Canada's 5-year bond yield. We could see that there's been sort of a change in expectation. In the summertime, approaching August, there started to be some consensus that we may actually end up seeing a Fed pivot, meaning as inflation were to start trending down, the bank would pivot on its stance of increasing borrowing costs precipitously. As a result, the 5-year yield bottomed out at around 2.57%. It has since rebounded quite significantly because central banks made it clear that the metric they'll be looking out for is core inflation. Over that period, we've seen core inflation start to embed itself in the economy. That's predominantly reflected in service-based prices. Service prices are largely driven by human capital, the cost of labor. And we know that we still have a very, very tight labor market, although it is showing some signs of softening. And wages are continuing to grow at a pretty substantial pace, annualizing at about 5.2% of annualized wage growth. If the Bank of Canada's target is 2% for inflation and wages are continuing to grow at about 5.2%, you could see core inflation remain entrenched for longer than originally anticipated. As a result, you've seen the Canada 5-year bond yield trend up from 2.57 up to 3.7. Over that time period, we've also seen the 5-year fixed mortgage rate trend up, likely from somewhere in the neighborhood of about 4.69, 4.79, up to about an average rate of, let's say, 5.39, depending on the mortgage product, the amortization, etc. Right now, central bankers have made it clear that interest rate hikes will not stop. The point of a video like this is just to help understand that there's two sides to the coin. We know inflation has been very high. As a result, we've seen borrowing costs increase precipitously. But we all are interested in what's going to happen moving forward, because a lot of people are considering making the commitment from a variable rate mortgage that affords them a lot of financial flexibility to a 5-year fixed mortgage, which today will be at a rate well above 5%. As a result, you're making a long-term commitment to a product that has very large penalties if you choose to break out of that mortgage early. There is a lot of risk in staying in a variable rate mortgage if you're on a single income, if your budget's already tight, if you're falling behind. You may want to create a ceiling in those payments by switching to fixed, but don't make the mistake of overlooking some of the intrinsic risks of a fixed mortgage. If you break that mortgage early, you may be facing very substantial penalties, particularly if you find yourself in an environment where interest rates start to fall. It doesn't mean you shouldn't do it. It's just important to understand the risks associated, and when you're trying to make the decision of what an appropriate action is, consider some of the information that we've covered here, but always speak to your professional. Speak to your mortgage advisor or broker, speak to your branch representative, or if you want to talk things through, have a look at my contact details in the description below and feel encouraged to get in touch. As always, thank you for tuning in. Please hit that like and subscribe, and I'll look forward to seeing you in the next one.